Good morning, children. Today we'll study about the capital structure. On the basis of the ownership fund, owners fund plus borrowed fund. So capital structure basically means that what all fund will be required by the business to run the business. There are basically two funds we have already studied, which is supplied to the business to run the business. First is owners fund and the second is the borrowers fund. Capital structure basically decides how much owners fund is required and how much borrowed fund is required. Owners fund is also called equity finance and the borrowers fund is also called the debt finance or debt. Now owners fund are the fund which the owners supply the money to the business. Owners fund are basically equity share capital, preference share capital, reserves and surplus, and the retained earnings. All these are together called as equity. Now borrowed fund is basically the loans, debentures and the public deposit. This is called the debt. Capital structure is basically the mix of long-term sources of the funds. And the capital structure refers to the proportion of the debt and equity used for financing the operations of the business. So capital structure basically means how much debt and equity is required, mix of both is required to finance the operations of the business. Now cost and risk are very important to determine the debt versus equity. Cost of debt is lower than the cost of equity. In debt we have already studied, debt means borrowed fund and borrowed fund means loans, debentures, public deposits. So cost of debt is always lower than the cost of equity, but debt is more risky than the equity, because if a company has taken the loan and if the company will not pay the interest of that loan on time to the bank, then the bank will close the company. So cost of debt is lower, but debt is always risky for the business. So cost of debt is less than the cost of equity, which is less than the owner's risk. Now lender earns an assured interest and repayment of capital. So all those people who have given the money, that is the loan, debentures or public deposit, they get an assured interest and then repayment of capital also. Interest on debt is tax deductible expenses, so brings down the tax liability for the business, whereas dividend are paid out of profit after tax. So interest on debt is tax deductible. Whatever interest is paid on the debt is tax deductible expenses, and as a result it brings down the tax liability for the business, whereas dividend are paid out of profit after tax. So dividend is paid out of profit after tax. Debt is more risky for the business as it adds to the financial risk faced by the company. So debt means loan is always risky for the business, and if the company will not pay the interest to the bank will close the business. Thus, it is always a financial risk is associated with the debt financing. Any default in the payment of the interest or repayment of the principal amount may lead to the liquidation. If the company will not pay the interest or repay the principal, then the bank will close the business. Capital structure affects both the profitability and the financial risk faced by the business. So any capital structure, it affects both the profitability and also the financial risk faced by the business. Optimal capital structure is that combination of debt and equity that maximizes the market value of the shares of the company. So what is the optimum or optimal capital structure? What is the best capital structure? That is the mix of the debt and equity. The best capital structure is the combination of debt and equity, which maximizes the share price of the company, which increases the share price of the company. So capital structure is basically the proportion of the debt to equity, and the best capital structure is the combination of the debt and equity that maximizes the market value of the shares of the company. Today only this much. Thank you.